Hey everyone, thank you so much for joining us. It's a great pleasure to have Kirk Northington with me today to talk about volatility-based support and resistance. Now, as some of you may know, we've got the toolkit that Kirk and Carson put together in Optuma, and it's just been one of those tools that have been absolutely blown my mind. You know, for 20 years, obviously writing a lot of technical analysis and writing a lot of these tools, and you know, I've got to say, most tools that we write, they probably take up about a page on the computer, you know, when you think of all the math that's involved. VBSR, I mean, this was amazing. This was probably floor to ceiling lines of code. I think it was back in 2013, completely had to rewrite all the foundations of our technical analysis library just to make this thing work. I think when we first had it going on the Dow Jones, it was about 20 seconds to load the chart. It was incredible. We were able to refine it and get it to be really responsive. So it really is an amazing tool. Now, again, many of you will know that I have an affinity towards Gantt type analysis and really enjoy the predictive calculations that come out of this. This tool here is as good as any Gantt technique I've ever seen. But what actually makes it even more powerful is it's quantitative and is repeatable. Where a lot of the Gantt is so subjective. This isn't subjective. You just put it on and there are the levels. There's no discretion about it. So it's really exciting, Kirk, to have you here. Thanks so much for taking the time. I guess the first question, because this really is one of those areas which is quite different for a lot of people, you know, I guess what was the journey for yourself to getting to this point?
Well, I don't come to financial analysis by formal background. For years, I was in an industry not at all related to technical analysis or markets. I was in an industry that did control systems for industrial processes. And so, you know, we were interfacing with nature a lot. When you're in that business and you're coding up control systems, and tuning what's called control loops, it's really man versus nature.
Right.
Okay. Yes. And nature works that way. Nature works at extremes.
Yes.
We see extremes in weather. We see extremes in human behavior. So as you can see, we fit right into nature, and just by virtue of us being human, and human hands are the market, you can see the direct transfer. Okay, from a behavioral standpoint. To be more specific, I came to this because I guess the same reason a lot of people come to it. They want to make money in the markets. And I was using my own money, so there was no room for hope or chance or luck. I bought a programmable package of software one day and just sat down and started playing with it. And seeing how well I could predict, you know, where a particular stock would go to, I started with very simple trading, and started learning technical analysis concepts. But I couldn't quite make them work as well for me as other people could.
Right.
So I started thinking, and then I heard a really good quote by someone who I admired at the time, Alan Farley. He said, if you're going to really profit in the markets, you've got to find your own original methodology and make it work for you. And make it work correctly until it becomes almost boring, and that's when you'll really make money in the markets. Have an advantage. So I started coding up really something that looked like a PID control loop back in process controls.
PID?
Well, mostly it's on P stands for proportional.
Right.
So if you were trying to control a temperature in a room, for instance, you would increase the amount of cooling or heating output.
Yes.
In which case you would do that proportionate to how far off you are from your desired temperature in the room.
Right. Yep.
Okay. And the other two are simply more mathematical methods for tuning that even closer.
Yes.
And getting out ahead of time. Okay. So it started to look a lot like that. So one of the first things you do in that process is you identify where your extremes are likely to be.
Yes.
And so I started looking at the chart, and I said, how far can it go before it really has to turn around? It always seems to do that at some point. There seems to be some rhythm to this, some limits to this. I don't see something going from 0 or $2 a share to 100 in a straight line. So let me see what I can do here. And it took me about 2 years from start to finish my trading bands that I ended up calling N bands.
Right.
And essentially, it's a point that price has to stop at.
Yes.
It just can't go any further, okay? Or it won't go any further. It was shortly around that time I started to call it resistance.
Yes.
If it was going up.
Yep.
And applied to it as support if it was going down. Even though everything I read about support and resistance from a classical technical analysis, that you didn't use it, you didn't measure that with bands. You measured it with trend lines and
with a straight line at a Fibonacci level or something like that.
Very linear methods. And this was somewhat non-linear in a way. And so, I worked on these for a couple of years, and the reason why is I just wanted a spot where I could say, okay, I think it'll reverse now, or at least it won't get much worse.
Yes.
I won't lose much.
Did you want to bring up that chart? We can bring up that chart of the N bands there, just so we can show everyone what we're looking at. So we're talking about this chart here, and this is essentially what you came up with. So these were the two bands.
Yeah, after several innovations and iterations and losses in my trading account, we ended up here.
Learning experiences, I think.
Yes, we'll call them learning experiences. We ended up here, and simply put, what you're looking at is two solid colored lines there, the trading bands, red above and blue below. And the above is resistance and the below is support. Inside of that is a dashed line, and that's one average true range below the band and one average true range above the band. And this makes up for daily noise in the market.
Yep.
We can measure a lot of things, but we're always going to be measuring noise as well.
Yes.
And the point at which you begin to encounter resistance or support is at that noise level, okay? Yep. And on this chart with Microsoft, I think this is a 65-minute chart, so it's intraday. And price goes up, for instance, on the 10th, and begins to get to resistance, okay? And the market has to sort that out. Now, the point of resistance is where buyers and sellers are going to battle it out.
Yes. Supply
and demand is going to battle it out. And it's either going to do one of three things. It's going to trade higher through resistance. It's going to trade lower so that the bearish sentiment and the bearish selling will prevail. Or it will trade to the side where neither wins, okay? One of those three.
Yep.
And that's what I call support and resistance at N bands. And really the reason why this is important is there is strictly volatility arithmetic, mostly the arithmetic you took in high school.
Yes, yes.
Okay. A lot of standard deviation, R squared, linear regression, some standard error. Not to go into all of the scientific stuff there, but a whole dish full of that on only historical data. We don't import any implied volatility or any external data. We're strictly using a classical technical analysis time series, open, high, low, close.
Yes.
Okay. And one of the nice things about that, and one of the things that makes any form of good volatility technical analysis work, is that it needs to be flexible.
Yes.
It's very important that this be able to work on any asset class.
Yep.
On any time frame.
Yes, yes.
And if it passes those two litmus tests, then it is truly robust and it is repeatable.
Yes.
If something only works on corn, corn futures, but it doesn't work on gold or stocks or other things, there's a certain amount of as we call it, bias built into that math.
Yes.
Okay.
Yep.
So this can work on any time frame, any efficiently traded, market traded security or contract.
Yes.
Okay.
Yep.
Now, since it's adaptable, it's volatility measurement. This is essentially volatility measurement, and it makes it self-adapting. That's what it has to be, because I didn't want to be trading with tools that would highlight my weaknesses personally. That's my personal journey. My weakness is trying to pick out, well, should this be a 33 period moving average right now, or should it be a 15 or a 10, or, you know, all these parameters that you put in. I wanted something that I didn't have to think about parameters.
So if it was a highly volatile stock, or a very low volatile, you know, the indicator was going to adapt
automatically. Yes, exactly, and that's what I needed. You know, many people don't need that. They can trade instinctively.
Yes,
and God bless them. I wish I had some of that.
Yes.
I needed something that propped up my weaknesses and went with my strengths.
Yep.
And so this is what I went to. And then there was an aha moment one day. I was on a trip to, and maybe it was just the environment, but I was in Hawaii.
Yes.
And my mind was very detached from, you know, what I would normally be thinking about. And I was sitting there, and we were up the side of one of the mountains, and I was in where I was staying, and I was looking out over the ocean, looking at my screen at a chart very similar to this. Then I would look out, and just the total relaxed nature of it made me notice something about it. It's that when I took the extremes, the peaks and the troughs of these bands, and looked forward from there, I could see points where price would stop and reverse, or stop and trade sideways, or pause for a while.
Yes.
And it seemed to happen repetitively.
So I think we've got an updated chart of that, and so this is what you're talking about there.
This is what I'm talking about. Yes. So after a little bit of time, I worked out how to project forward some lines directly from the peaks. So if we took this chart right here, and we took the peak formed in the N band, the upper N band, on the 11th. We took that solid line. If you look to the right, there is a projected pair of lines going forward. That's a resistance zone. And those two lines are plotted from the N band line and the resistance zone right beneath it. Okay?
Yep.
They plot directly forward. And they pause a few days, or they pause a certain quantity of hours, since this is a 65-minute chart.
Yes.
Because we need to confirm that we've put in a peak.
Yes.
That's part of the
thing. So it has to be
that
like a retracement off the peak.
That was some of the fun you had in coding.
Oh,
you
yes,
remember,
it
Matthew?
was. It was lots of fun.
I tried to explain you can't have a peak until you have a trough.
Yeah.
Well, when do you get a trough? Well, once you've had a peak.
Yes.
And that's not easy to code.
Yep.
And so you have to confirm a peak or a trough.
Yep.
Okay? Because you don't want to have a peak and then not have a peak, etc.
Yes.
And so this zone, when projected forward, begins to say, hey, why does price stop there and reverse? So let's look at this chart here. At the trough on the 9th or the 10th, we have a resistance zone that is projected forward. And almost at the exact same spot, the actual trough resets on the 16th. It's not easy to see there, but projects forward. And there.
You can see the market just bounce straight off it.
Yes.
Yep.
This isn't the best example because it also looks like it's also bouncing off a previous high.
Yes.
And it's not at all looking at previous highs or previous lows.
Yes, and that's important, isn't it? I mean, it's so adaptive that it's not like a Fibonacci where we're going back saying, okay, this was a previous top or bottom in the market, we're looking for bounces off there. This is very different, and it's, you know, it is just amazing how many times the market does react to these zones.
And in a few minutes, I'll get into why this works, but we can look at some more for a couple of minutes before we get into that part.
Yeah.
But these support and resistance zones project forward and essentially give you support and resistance. So I didn't invent support and resistance. I just reinvented a way, an adaptive way to calculate it.
Yes.
Okay. Today's markets are so volatility measurement dependent that volatility and all the ways that you can measure it are much more predictable.
You were explaining this to me before, where you're saying that some of the work you've done with some of the larger banks here in the US, that the restrictions that are placed upon them mean that they're making decisions not based on whether it's been a profitable trade or whether, on any of the normal type of measures,
right,
but it's purely based on volatility.
It really is. It really is. I've been in market risk with Wells Fargo and Bank of America in two very unique positions, I feel. I felt very fortunate to be there. I should have been paying them just for the experience, to be honest with you. The first one was in risk, and this was post-crash, along about 2012 or so. And this was when Dodd-Frank was beginning to be implemented.
Yes.
So they'd been mulling it around in sessions for a couple of years, and now the new risk models were coming out from the Fed and Basel, et cetera. And so all I did was look at data that was fed into those risk models. And this would have every impact on whether or not the firm and all of its counterparties could increase or decrease their size in these baskets, these positions, these hedges. These were not simple trades. This was affecting all the bank's products all across the asset sheet. And the interesting part about this is what was the most interesting part for me. The actual, let's take for instance one classification, bonds, interest rates. The actual data that the bank was really procuring and using, very little of it was the actual yield. It was all volatility data. It was, there would be anywhere between 10 to 20 different volatility curves that we would have a full matrix of data coming in every day on. That's what fed into the risk models. The actual rate that it was at
didn't matter.
Didn't matter. The yield didn't matter. It was the potential for movement.
So they had to comply with staying within the risk limits.
Exactly. Exactly. And banks, trading institutions, etc. Those restrictions were not put on them nearly so much prior to the financial crash of 2008. But afterwards, it's all about that. And I'm going to say at least 96% of the data that are in these multi-million-dollar budgets for data for these risk models is actually volatility data.
Wow.
It's just amazing.
So it's huge, and so that's where, if we're managing a portfolio, if we're doing anything, I mean, the reality is that these banks are the behemoths of the market. If they're making moves based on volatility, then we need to know, we need to watch volatility, because otherwise, there's this massive input that changes the structure of the market, and we're blind to it.
Yes, absolutely.
And so that's why volatility is so important. It's so important for us to understand.
And it's tracked on a daily, weekly, monthly basis. The part of the Basel Accords, a very unique part of it is called the Financial Stability Board. They're a sub-organization to the Basel Accords, and they work through each country's main central bank. They work through our Federal Reserve, in implementing specific risk models and specific reporting models. One of the most key ones that recently got put into effect was put into effect in 2015, and it went live in early 2016. Now, every globally, systemically important bank reports all of their obligations. and all of their counterparties' obligations
Yes.
to the Fed, which then goes up to the Financial Stability Board.
Yes.
So everyone's reporting on each other. No one can hide where their real exposures are.
Yes.
That factors into the Fed's risk models.
Yes.
And whether or not these risk models are actually working.
Yes. Yes.
And so the Fed, along with Basel, has completed finally a full 360 loop.
Yep.
And frankly, you can say what you will for regulation. Some of it, like that, makes a lot of sense.
Yes.
You should know that your bank and your government isn't on the hook for excessive risk-based trading, and they're controlling this strictly through volatility models and volatility math.
Yep.
And where this affects all of us is their balance sheets, as far as securities go, consists of treasuries. It consists of stocks. It consists of baskets of commodities. And the actual selling and hedging and buying and bets on those securities is done based on volatility data, not where the price is. That moves everything.
Actually, a question I have on that one. To your knowledge, are the volatility models separated in upwards volatility versus downwards volatility, or is it just straight volatility, up or down, doesn't matter?
Well, one of the weak points that they have is that they're heavily dependent on centralized tendency.
Okay.
Most of the models I've seen use central tendency as a way to calculate risk.
Yes.
Okay? And that's a good thing.
Yep.
It's a bad thing because it's not as accurate.
Yeah.
It's a good thing for us because if you're using something that isn't central tendency dependent, then you can have an edge.
Yes.
Each of the N bands, for instance, is calculated independently.
Yes. Yes.
They're not calculated around a central tendency.
Yep. So the lower band and the upper band are complete separate calculations.
Yes.
Yep.
Yes. And because you're calculating an extreme, an upper extreme, differently than you calculate a lower extreme, it's more accurate.
I just wouldn't mind just taking a minute just to really explain, because I think this is a really important point for everyone who's watching. You know, when we talk about standard deviation, when we talk about volatility, the typical way is you work out an average, you work out, okay, what's the variance from that average when I look at all the data points, and then from that I work out the standard deviation. And so much of value at risk and a lot of the standard risk measures are worked that way. So we're taking upward volatility and downward volatility and mixing that all together. But anyone who's been around charts for a long time knows that we go up the stairs and down the cliff. And our downward volatility and our downward movement is very different than our upward. So, you know, what VBSR and Kirk's done in this whole model, which is so powerful, is that it is that separation. And so we've got a lot better, a lot more accurate model here than your standard value at risk and other type of risk measures.
Yes, yes, so, yes. By separating yourself from central tendency, you tend to get away from the things that make that weak, and the outcome of that. The primary outcome of that is not to being able to predict things that are way out and unpredictable.
Yes.
Okay. I'm not saying that people like myself and other methods that I use can predict the unpredictable.
Correct.
But it is better at predicting black swans, etc.
Yes. Yes.
For instance, okay, overnight information changes.
Yes.
Okay. Overnight information changes. We all know that for a lot of different reasons. The market consists of technical information, and it consists of fundamental or qualitative information.
Yes.
Okay. Microsoft says, "Ooh, we've sold a whole lot more of that Windows stuff than we thought," and that came out at 6 a.m. in a news press release. Boom! Wow, that's really big news. Okay.
Yes.
There's nothing to predict that in technical analysis, and in my opinion, technical analysis tends to take a back seat to fundamental analysis.
Yes.
But you know, there's nothing to predict that. You can look at one of the effects of that on the chart. Could we bring this chart up here?
You got this chart there.
This again is a recent, I think it's a live chart.
It's a live chart going with Microsoft right now, 65 minute.
We've got a live chart of Microsoft here. Let's look back on the opening of the 7th.
On the opening of the 7th, right
Yeah,
here.
right there. We've got a jump. Something came out in the markets, either about Microsoft or the broader market. Something came out and investors were happy. So there's a great big gap right there. Well, one thing that N-bands will tend to do in the real time is when no one quite knows how to fundamentally or qualitatively value something, it will define the limit that the jump occurs on.
And it is actually amazing to think that actually that jumped straight into the N-band and stopped.
And we see this a lot around earnings announcements. It'll go straight into an N-band of a daily or more often a weekly N-band. You know, like I said, these things need to work on charts of any periodicity, right? And so if you look again on at some point during the 9th,
we obviously got some bad news.
We obviously got some bad news. And was that the election?
9th.
I think the 8th was the election.
8th was
Anyhow,
election.
we got some bad news. And that bad news, boom, it went right down to the N-band, as well as a support zone right at the bottom there. Okay, that would be a support zone, and it traded off of that. So the extremes are what qualify and quantify risk. And identifying those streams is where you can make the most money. That's my motto, is that money is made at the extremes. Now, also, it can be the hardest place to mentally take the trade. It can be.
The market's going in the opposite direction to you at that point.
And it looks like, you know, the falling knife, trying to put the pin back in the grenade, etc. One of those things. And it's very hard to do. But let's remind ourselves that the most successful traders are mentally, psychologically not wired like other people are. Study after study after study has proven that where you see fear, they see opportunity. And where you see opportunity, they see fear. And that very much describes volatility analysis of trading. It really, really does. So as you can see on this chart, we have zones projected. Some of them are significant. The long and short of it is, when price is away from a zone or a support and resistance, the longer it's away from one, then the more significant a particular resistance zone or band becomes. If it's sitting there trading around it, that zone is not very, very significant because that level has been fought over already. So if we were to take an example here of, let's say, some hourly trading on the 17th and the 21st, we have price rising into a level on the, let's see, that would be on about the 22nd.
Let's just jump on this bar here we're talking about.
Trading up to near resistance and then trading down again. And then, again, on the 29th, price trading back up to a resistance zone, higher than it did earlier. Remember what I was talking about earlier, is that previous highs and lows, that sort of linear analysis is not what this is based on. And this has its strengths, I think, where perhaps some other forms of TA has certain weaknesses. So it's good to have that in your quiver as well.
So let me ask you a question about the bands then. So we've got these bands and we're calling them support bands and resistance bands. Do you take the position that then, especially in this context, that resistance is a zone rather than a fixed price?
Yes.
And I think that's one of the really powerful things, and you know, even as we've done work in Fibonacci and things like that, too many people get hung up on a price. And you know, I've done so much work and I'm like, look at this resistance line, and people are like, yeah, but it broke through. It's like, they're elastic. You know, you've got to have this zone concept, and what you've done here really displays that so well.
Well, I think it's important to remember what it is that we're working in.
Yep.
We're working in markets that consist of certain things.
Yes.
Okay? The vehicles by which the market actually functions.
Yep. Yep.
To use an academic term, it's typically called a market's microstructure.
Yes.
Okay?
Yep.
And I wrote about this in some of the blogs that we
Yes.
posted on the site.
Let me just make a quick reference to that. So Kirk's put 4 blogs on the optuma.com/blog. The first one is the Sandpiper and Trading.
Yes, yes.
So look up that article, and from there you can go through the rest. It gives a bit more detail and explanation behind what we're talking about here today.
Yeah, okay. I'll tell you what, let's switch to a daily chart of Microsoft, if we would.
Let's change here to daily.
And so I'm going to go ahead and say, let's remember what the market consists of. And the market consists of a lot of large institutions trading based on contracts and derivatives. Virtually all the hedging and positions taken by the globally systemically important banks, as well as larger hedge funds that are not regulated, is done based on contracts, not outright buying and selling.
Right. Yep.
In fact, the outright buying and selling happens more as a knee-jerk reaction to the actual contract positions.
Yep.
Okay, either exercised, not, etc. And those contracts are typically options, futures, and sometimes options on futures, etc. All of these contracts are what really moves the markets. All of these contracts are essentially calculated, structurally very similarly. And the number one input into the pricing model is volatility. Okay? Is historical volatility. Okay? Where the price of a security is one thing. But its volatility is the single largest factor. Okay? Now, so let's try and look at that in terms of what we see here on this chart. So if this is a daily chart of Microsoft, most of the buying and selling of Microsoft is going to be through derivative contract. Not by outright selling and buying. Okay? So you've got people making commitments at certain points, okay, forward on options, let's say. A person says, I've made a commitment that my strike is, let's say, I don't know, $60 strike. Okay? And I'm buying contracts back in July and September. Okay? All right? And I've got a $60 strike. Once I go above that $60 strike, I either start making money or I start losing money.
Depending on whether it's a call or a put.
Exactly. Exactly. Long about the end of October, it looks like something happens, and there's an awful lot of fundamental information enters the market. But you've got commitments going in at certain strike levels based on certain volatility amounts, implied volatility, for instance. And these things work their way into decision structures. Most of these decision structures are not inside of people. Most of them are algorithmic trading platforms. And they're going to happen automatically. Okay? That's all there is to it. These volatility calculations and projected forward resistance support levels based on the extremes, that is what ties into this. That is what ties the two together. So essentially, a support resistance zone in the future is essentially just a combined level of support and resistance based on projected implied volatility. Okay?
That is amazing when you think about it. I mean, it's making my head spin at the moment because we're obviously not using implied volatility data.
We're not.
We're not even looking at the options.
We're not.
And we are coming up with a zone which is predicting what implied volatility is going to be.
We're coming
saying.
up with an artificial implied volatility, yes.
That's
and
amazing.
if you were to trade options, you would
Yep.
see that in an option montage,
Yes.
you have really a grid of
Yes.
different options contracts that you can buy or
Yes,
sell
yes.
based on its expiration
Yep.
and its
the
strike
price.
point. Right.
Yep.
So forward projected implied volatility is supposed to and does represent a conglomeration of the implied volatility of
Yep.
each of those option contracts. Each one of those contracts with a different strike
Yes.
and a different expiration will have its own implied volatility based on what people are willing to pay for
Yes.
that option.
Yep. Yep.
Yeah.
Yep.
And so if we took all of those and could magically, I'm just going to say magically because this is trade secret,
Yeah.
but if we could come
Yep.
up with a way to find out the most weighted and the most important
Yes.
implied volatility going forward, then we would know a level
Yeah.
at which the market will achieve
Balance.
and
Yep.
parity. The
Yep.
bulls and the bears are going to fight it out.
Yep. Yep. Yep.
And that's essentially why this works.
Yes.
That's what makes this work.
Yes.
And so as we look at this chart, we look at the fundamental information that hit it with a gap up, okay?
Yep.
And again, we're looking at a daily chart, okay? Price gapped up to just outside the end band.
Yes.
And then the bear stepped in and said, whoa, wait a minute. Now let's do something else. Let's note the date, and let's say that's October 21st. Now, honest, I swear I haven't seen the chart yet.
Yep.
I don't know what we're going to look at. Let's flip to a weekly chart of this.
A weekly chart. Do you want to put them side by side, or?
Sure. Yeah, let's do that.
Let's just do that. So what we're going to do is just drag this across. I want to clone that chart, and let's change that to a weekly. And we're going to zoom in, and let's find our October 21st.
Okay.
There.
And so what we have here is a zone of resistance on the weekly chart.
Yep.
That was confirmed in what looks like late August of 2016.
Yep.
It then projected a zone of resistance forward, okay? And that resistance stayed in place for a certain quantity of bars there.
Yep.
Okay? And then along came the news, price traded through the zone to the top of it
Yes.
and over that resistance. The point I'm trying to make is that quite often you'll find that, and really most of the time, you'll find that these weekly, daily gaps
Yes.
have overlap. So there is a resistance zone that ends right above the end band, essentially.
Yep. So we're talking about this bar to this bar is covered in this week here.
Exactly,
Yep.
yes.
Yep.
So the zone of resistance, to get over it,
Yes.
technically, the most important line of these two lines here is this line right here, the
Right.
top one that corresponds with
The top end band.
the trough
Yep.
of this end band.
Yep.
Price then trades to a point where it can get over that, which occurs on these few days.
Yes.
And then they fight it out. Now, another interesting thing is going forward, this zone of support resistance, which is really going to become support if it stays up here long enough, okay?
Yes.
Once we go forward here, if you want to push us forward there a bit,
All right, let's just drag this chart across.
you can see that that zone then becomes a support zone. Price tends
Went
to
through,
stay
yep.
around it,
Yep.
okay? And then it's finding support at that zone, essentially.
And this is probably another good point to make quickly for everybody. When you look at this chart here, and you see that we have our blue, which we, even in the properties, we label these as support zones, and we say color the support ones blue. Well, in this context here, when price has gone above this resistance zone, like traditional technical analysis would say,
Yes.
this becomes support.
Once
in the future.
resistance is
Broken.
breached,
Yep.
once it's broken, then it becomes support.
Yes. Yep.
And I contend that so long as you get a decent amount of market activity above resistance,
Yep.
it then becomes support. I personally think you need, 3-4 bars above resistance before it becomes support.
Yep. Yep.
Because sometimes things take time to work their way out in the market. Now, I think that some people may be wondering, this is all great, but how do you profit from it?
Yes.
Right? It's really, well, one of the hardest things to do is to set profit targets. When should I take my money off of the table?
Yes.
And frankly, I think it's been shown that one of the most difficult things to do from a discretionary standpoint is to exit well.
Yes. 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 It's one thing to enter the trade, but then to know where's the point where I say that's it.
Exactly.
Now I'm out. Yep.
And I've had people using this for 5-6 years now.
Yes.
And the best feedback I've gotten is that they tell me it's the best exit signals they can find.
Awesome.
That's what makes them the most money. It's very profitable on an entry, from an entry perspective, and knowing your risk when you enter.
Yes.
But knowing how to take it off the table and at what point to hold to seems to be the single largest strength that it has.
Yeah, yeah.
And fortunately, that seems to be the area that most trader coaches say people could make the most money from by improving.
Yeah, yeah. Yep. People are either getting out too early, and missing out on profits, or holding on, with a losing trade.
Yes.
So, yeah.
Exactly.
Definitely.
Yeah.
There are so many areas that we could go right now, and I'm conscious of the time. We may even have to get you back for a second session on this. One thing that I think is worth just pointing out is we have this little section of overlap here. And I remember you telling me a bit about overlapping zones. And that
Yes. When two zones of resistance or two zones of support come very close together, it forms a much tighter, more reliable, more predictable set of circumstances that you can make trading decisions on.
Yep.
And we call this zone a compression.
Yep.
Okay. In this case, this is very common for it to go up into the zone of support resistance, and then go back down to the bottom.
Yes.
And trade inside of that for some period of time.
Yep.
That's very common. So this, I swear I hadn't seen these. I haven't looked at Microsoft in a while, and I'm not holding Microsoft right now either. So
again, I want to sort of just reiterate for everybody, Kirk and his partner Carson are two of the most quantitative technical analysts I know. And when Kirk says most of the time, you can be sure that there has been a lot of quantitative testing that stands behind that statement.
I had to if I was going to put my own money into it.
Exactly.
It's just different when you're trading your own money.
Yeah. Yep.
Yes, we've done quite a bit of research, and we know the statistical probabilities of what happens when you, for instance, trade to a compression zone.
Yes. Yep.
We've put a lot of work into understanding those numbers.
I was just looking for another compression zone back here, and again, obviously in this instance, don't know what the news was back in January 2015, but straight up and bang into the
what does the weekly
zone.
look like at that point?
Let's have a quick look. Let's go to 2015 there. I should be tracking actually. Let me just quickly change this. A quick thing that you can do is we can track that change, and so now I can find that there. All right, so
goes right down to the weekly line, and what's happening here is, it's pre-market.
Yes.
In New York, and there's some really bad news.
Yes.
Let's call it, I don't know what it is, maybe that looks like about the time earnings come out.
Yep. Yep.
And nobody really can sit down and do all the qualitative calculations to know exactly what the financial impact per share is on Microsoft. So then they say, well, what does the volatility calculation say is worst case over the next month?
Yes.
Bing, that's a weekly N band.
Yes. Yep.
Yep.
Now, one of the things, and again, I'd love to sort of just quickly talk about, and that is the whole concept then of risk and reward that you layer into this. More, getting more into the practical usage of this. And what I may do is I may just bring up now, in the last couple of webinars, we've been talking a number of times about just this, let's say, this fund I've got of about 110 tickers. I'm just going to open them as a watch list for the moment. Let's just bring up one of the charts there, and I'm going to add on our volatility-based support and resistance. Change to a candlestick chart. Now, you had this concept that you explained to me about risk and reward at any point in time that you use with this. Do you mind just quickly sharing?
Sure, yeah. So if I'm going to take a trade, I want to know what my risk is. So where's the support under me?
Yes.
And then I'm going to know, well, what's the potential above me?
Yes.
Okay. Certainly people have heard something like a risk-reward ratio, and they figure out that it can only go down this far.
Yes.
And yet I think it can go up this far. So that's 1, 2, 3. That should give me about a 3-to-1 risk reward to risk ratio.
Yep.
Well, using that same concept, we figure that if you're trading and you take a trade just above support, okay, for some period of time you should have some statistical probability that price isn't going to go through support. Okay, and that is how it works. Actually, we give ourselves a good 3-4 bars. For we know that, okay, I'm probably not going to go below support for the next 3 or 4 bars. Okay, and if I start to go below that, bar 4 or 5, I'm out. Okay, I know from that point on, the bears are going to start winning because the bulls have
what was support. We've breached it, and we're now in a new environment.
But same thing, above it, I see, okay, the next area of resistance above me is, let's say, in units of average true range, let's say it's 4 units of average true range above me. And I've got 1 unit of average true range below me. Well, then I have a 4 reward to 1 risk. What we try to do is to make this much simpler, because if I can look at this chart, I can see various points of support and resistance, but it only really matters where I'm at right now. So let's look at the hard right edge on that chart. I'm pretty much at support right now. Okay. So if I believed that the trend was going to continue, this would be not a bad place to maybe enter that trend, because I'm at support. So if you want to turn on the support resistance risk reward ratio tool.
So that's R when you've got the module.
Now it's telling me here, it's doing the math really quickly for me here. Okay, so the algorithm works out where is support right now. Okay, so it's got me at support being at, well, what's the number there?
What's the number that's coming down here? Let me just turn that on there. So we've got the 2 values now in the price scale.
Okay, so right now it's got me at a 1 to a 1.5 risk reward ratio. So as you can see that the last bar at the end has about 1.5 units of average true range above it before it'll hit that N band. And it sees the red support zone there coming over as support. Okay?
Can I just jump in quickly again, because you've mentioned twice now average true range, and I think for a lot of our people who are watching and listening to this, I mean, you've just breezed over something which I think is actually really powerful. Because when you're comparing, let's say, Microsoft to Adobe to ExxonMobil to the US dollar versus the euro, you've got all these different units, different prices. It's not enough just to sit there and say, let me measure the price differential, because that's going to be so different for every single security that I look at. But what you've done is you've measured this in units of ATR. So now you've got a way of measuring and comparing different equities, different asset classes even, and being able to work out, well, what is my risk to reward based on that?
People like myself are fortunate. We stand on the shoulders of some really great technical analysts over the years. The great Wells Wilder developed average true range as an adaptive measure of any chart's volatility at any point in time. People such as John Bollinger and all the work that he did with Bollinger Bands over the years, and some of the concepts that he worked out. We really are very fortunate that these giants in technical analysis did this work for us beforehand.
Yes, indeed.
So what average true range does in our case, it gives us an ability to have a simple yet really powerful unit of distance of measurement. To say that, okay, right now I've got price that could fall 1.5 average true ranges below me over the next few days, or it could go up by
1 unit.
By 1 unit, you know, and so that's not really all that great. Okay. Yesterday it was a little bit better because it wasn't so far down and it was seeing a different level as support. And that's part of what we try to do is make this simple. Let the algorithm do it for you, if you will.
So the ideal thing that we're looking for, and maybe we can just jump through a couple of these codes here. You know, again, we're looking here at a stock where there is a lot of risk. You know, immediately we can look at this last bar and see there's 6 units of risk to 3.5 units of reward.
Right.
And keep going down. Still not seeing anything. I'm going to use the arrow keys now. I'm going to see if we can find something which is a little bit better. There we go. Now this is a bit nicer. We're coming out of a support zone. We've got 4.5 units to 2 units. Now, whether that's an acceptable reward to risk ratio depends on your own trading plan and what you're trying to achieve. But you know, that's definitely looking a lot better.
But we may also have visually a downtrend there.
Yes, true. You
know, if you're a trend follower, you tend to look for areas where these support resistance zones are resetting higher. And not lower. You know.
So again, this then comes down also though to what you were saying about the multiple time frames, where you'd be then looking at a weekly, you'd be looking at, well, whether you go monthly or not, but you're looking at different time frames saying, do I see confirmation that yes, we're in and up and there's room on both?
Maybe I could switch this to a 65-minute chart. Let's try that.
Let's just quickly do that. We'll go here to 65-minute.
Okay, here we go.
Oh, hang on, just waiting for the data to load.
Okay.
There we go.
And we see things being played out between bulls and bears in that last resistance zone there. That could determine whether or not price can go higher. Can it trade above that level for 4 or 5 bars? You may have something where it is a good trend entry if we're going to have some sort of short-term reversal. Okay. Yes.
So look, there's so many different ways, and we've only got a couple of minutes left before we hit the hour. You know, and I guess another thing which is worth showing, that for the people that are very interested in using this, you know, we can sit here with our fund or our portfolio and we can say, look, let's just chart all of this using a market intelligence chart with the risk and reward. And essentially what it's going to do now is give us that last bar for every single security in our portfolio. So I can sit here and I can even order this and say, right, let me see which are the equities right now that have the greatest potential reward. I mean, that's 11 units. What the heck is that one?
It's wide open.
It's Alcoa. So Alcoa, let's just put the tool on. We are running, so obviously the big pop there in the N band because of the upward volatility. But we're running a lot of potential room on the upside, which would make that one very interesting. So there's so much that you can do with that. Any sort of thoughts on sort of last comments you think that would really benefit someone who's listening?
If you're looking to exit something and you're from a long position, let's say, it's always nice if someone else is looking to short it.
Yes, yes.
And so look at things where, instances where in a shorter time frame you have a risk to reward where your risk is large and your reward is very small.
Yes.
So that would put you exiting near resistance in the short term. You know, play the better part of trends rather than the whole trend.
Exactly.
You know, be tactical.
No, that's excellent. So look, we really hope that this has been beneficial. Thank you so much, Kirk, for coming in. That's been absolutely fantastic. You know, I've learned again a lot more about all of this, and I've programmed all of this at least once. So it's been really good. Again, hope it's been really beneficial to you. Thank you so much for taking the time to watch this. If you'd like to trial, if you've got Optuma and you'd like to trial the VBSR toolkit, please just send us an email to sales@optuma.com and we can arrange that for you. The module definitely is very powerful, and at $50 a month, it's an absolute steal for what it can do for anyone's trading and their portfolio management as well. So again, thank you very much, and we'll see you next time.